Okay, class. Good evening, everyone. Can anyone confirm that you can hear me?
Evening, sir.
Okay. Good evening, Shiduma. All right, so you're welcome back to our class. And tonight, we're going to pick up from IFRS 15, revenue from contract with customers, that we're supposed to move to some advanced part of it, but which we have not done. So we need to, that's basically what we're going to finish up. That's basically what we're going to finish up tonight. Then it will be left with IES 12. There are some advanced questions. We have already treated most part of it. Just some advanced questions I need to solve for you so that we know that we are completely done with that as well. So as far as IFRS 15 is concerned, remember the core principle of IFRS 15, that is to ensure that revenue that you recognize actually depicts the consideration you're expecting from the transfer of goods or services. That's the core principle. Then we looked at the recognition and measurement using the 5-step model. This model is extremely important as far as revenue recognition is concerned. It's all about this model. Starting with the step 1 that talks about identifying the contract with a customer, to step 2 that talks about identifying the separate performance obligation, to step 3 that talks about determining the transaction price, to step 4 that talks about allocating the transaction price to separate performance obligation, and step 5 that talks about recognition of revenue when performance obligation is satisfied. I taught you this step 1 to 5. We explained the criteria that must be met for a contract to qualify under IFRS 15. We mentioned, I gave you like 6 criteria, right? And I told you that the parties must approve the contract. Each party's right and obligation in the contract must have been identified. Payment terms should be identified. Contract must have commercial substance. It must be probable that the seller will receive its consideration, and the contract can either be in writing, oral, or in line with any other customary practice. Furthermore, on step 1, we talked about contract modification and also contract combination. I explained all that to you. Then we moved to step 2 that talks about identifying separate performance obligation. This step 2 is very important because this is what determines the item. This is what determines the line item in your account that you are going to recognize revenue on. In the sense that if you are selling more than one different types of commodities, if you are offering more than one service, those services that you offer are what we call performance obligation. So step 2 talks about your ability to identify separate performance obligation. And this is particularly important for entities that render bundle of goods or services. So because there are instances where you would render some services together, but by looking at them, they are separate. Those services you are bundling together, they are actually different services. And I told you that the way you identify that a performance obligation is separate is where it has a distinct function, and also if it has a distinct profit margin. If it has a distinct function and a distinct profit margin, you should know that most likely that performance obligation is separate, where you can use the item that if you sell it to customer, they can use that item on its own without needing any other item with it. Or probably they would have to use it with any other resources available with them. But distinct function is they can use it on its own. And also, the way you know that it's separate is if that item or performance obligation is separately identifiable. If it's if it does not integrate with another goods or services, if it is not dependent on another goods or services, that it doesn't, it's not like an input to another goods or service. It is a standalone goods or service. Then it's separate. So when you have items that or goods that you sell, which you call performance obligation here, that are separate, we'd expect that you identify them as separate and you recognize revenue on them separately. So this is particularly important for entities that sell multiple goods or services or that bundle goods or services together, as it were. Just like a software company that installs software for you, or in fact, that sold you a software license, install it, and they run maintenance for you at the same time. So, those are three services mostly bundled together. So even if they are bundled, are they separate? If they are separate, then you should recognize revenue on them separately. And that is where transaction price comes in, which is the consideration you're expecting in that contract. The money you're expecting, the consideration you're expecting, that's the transaction price. Whatever it is, it could be cash, it could be non-cash. In fact, it can vary. It could be variable, can change. That, okay, if you meet some condition, we increase it or we decrease it in form of penalty. It's variable at times. And it's usually factoring in time value of money. And again, after you have determined transaction price, you will usually then allocate that price to the separate performance obligation you have identified. And this is particularly important in scenarios where entities sells bundle of goods and services. They sell many services together as one, right? But really, when you look at it, you find out that they're actually separate. They are distinct. And in such scenario, you will need to recognize revenue on them separately. And for you to do that, you will need to allocate transaction price to them. And that's what step 4 is talking about. Allocating transaction price to separate performance obligation. So any performance obligation that you have identified as separate, you need to allocate transaction price to it. Even if it is not priced separately, you need to allocate to it. And we solve questions on this. If you had revised this material, to have really solved your problem to a very large extent. And finally is then recognize revenue, which is the last step. And you see, you can either recognize revenue at a point in time or over time, depending on the nature of the goods or service. If it's a goods or service that you just deliver immediately, then you would usually recognize revenue at a point in time. But if it's a service that you render over time, that the customer will pay for like a year and you are rendering the service in bits, it's not something you render immediately. In such scenario, you will need to also recognize revenue in bits, so over time, right? And you see, when to recognize it over time, it depends on the nature. It depends. So you can either use like percentage of completion, meaning output method, looking at what have I done against the total of what you're supposed to do. You use that to recognize how much revenue have I made to date. And you can use impute method, which is the costs that you will need to incur to provide the service. You can use that by considering what cost have I incurred to date, all upon the total cost that you need to incur on the entire service. You're free to use either of the method to recognize your revenue over time. Like us now at our center, for most of you that has paid, in fact, any money we have collected, now that's our transaction price. We cannot recognize the entire money as revenue as of now because the performance obligation is rendered over time, right? So we can easily use output method. Like if you want to recognize revenue at the end of February now, we can do 2/4. The lecture period is 4 months. Can do 2/4 times transaction price to determine how much we are going to recognize to date as revenue. So we can do that, and that's output method. That's output method. So, but when you're recognizing revenue at a point in time, when you're recognizing revenue at a point in time, it means that you must have transferred goods or services. You must have transferred control, not just goods or services alone. In fact, the important thing there is control. You must have transferred control to the customer. Customer must have control. And you know what control means? Control means that the customer has legal right over the goods. The customer has physical possession. You are then entitled to your money, and we don't expect that you collect back the goods from the customer. That's control. So we need to be sure that, yes, you have passed control. As soon as you have passed control, then that is when you can recognize the event. So at a point in time, we need to really check, has control been transferred? That's the major check there. So what I've done for you now is I've revised what I did in the last class. Now, the purpose of this class tonight is not what I've been saying since morning. Is some application, there are some specific parts, some application guidance. Sometimes I call them practical scenarios that we need to look at, that the examiner specifically asks you on. So we need to look at the following areas helps apply the 5-step model. So following practical areas, and I think I will discuss, standard really talks about like 5 or 6 of them. I will discuss sales and right of return. You see it in your exam. We can ask you a scenario around it and see whether you can apply the 5-step model there. I will talk about warranty. I will talk about principal versus agent. Can see a question around this. I will talk about consignment arrangements. I'll talk about bill and owed arrangements. And I'll also talk about repurchase agreement or arrangement. So I'll talk about these 6. Then we'll solve some past questions, both ICAN and deep IFR. Then we'll be done for tonight. So let's see how fast we can cover these entire parts. So let me start with sales and right of return. And the meaning is quite straightforward. Okay. So this means that the customer has a right to return the goods or services to the seller. And this can be for a variety of reasons. That's not the focus here. Whatever the reason, whenever there is a contract and the contract states that the customer has right to return, then the principle here is what we will apply. Okay? And this right of return is usually contract driven. So it will be a contract that will have stated that you guys would have agreed that the customer can return the goods. Now, the main argument here is this. So the main argument here, or the main accounting issue here, is to determine whether the seller has transferred control and therefore can recognize revenue. That's the main thing here. Because since the customer can return, right? He has a right to return. Then the main accounting issue here is that whether the seller has transferred control to the customer. Has it transferred control of the goods or services to the customer, and therefore can you recognize revenue? Now, that is what we want to determine. And how do we determine that? Okay. So the idea is this. You see, the seller cannot recognize revenue on goods which the customer has right to return. A lot of people make this mistake in practice. So if the seller or if the customer has right to return a commodity, you cannot recognize revenue which the customer has right to return until the period within which the customer right to return expires. So until that period expires, you cannot recognize revenue. Then, after expiration of the period, then the seller can recognize revenue. So that's the whole idea here. So when there is right of return, do not recognize revenue until that period expires. Now, on the period within which the customer within which the customer right of return expires, then after which you can go ahead and recognize revenue. So what would then be the accounting treatment for the goods sold on right of return? So let's assume the customer has paid. Let's assume the customer has paid. What are we going to debit? Who can tell me? If you have received money, what will you do debit? Let me see this data in class. Okay, I don't have Fashion in class. Okay, I have Moses, I have Michael. Okay, those ones participate. So that it's, and I have Echo too. Echo to participate. The others, I don't know. You don't talk. Oh yeah, Moses.
Please, can I try, please?
Yes, please, Moses.
Yeah, since you cannot recognize the revenue until the return expiring date due before you can recognize such revenue, meaning if the customer pay at the point of buying the goods, now you debit your bank account. That means you cannot credit your revenue immediately. That means you credit your liability account. That means the
Correct.
money is still a liability to you.
Correct. Perfectly correct. So we
Now,
actually call it refund liability. Okay.
refund liability. You
So
credit your
continue.
refund liability. Now, if the expiring date due and you are sure that and the goods, you are now certain that the customer cannot return the goods any longer, you credit your revenue account, then you debit your refund liability.
Sherry. Sherry. That's absolutely correct. That's absolutely correct. Absolutely correct. Credit revenue. That's correct. But there are some hidden treatments. Hidden. There are some hidden things. Hmm? The hidden things are this, eh? So you know that you have sold the goods. You have sold the goods. So and you did not recognize revenue. You did not recognize revenue. So what do we then do with uh what do we do with because you have inventory. There is inventory in your books, eh? Your inventory will have, you need to reduce it. Your closing inventory will have reduced. Your closing inventory will have been impacted because you have sold goods. So, and additionally, um, since you can't recognize revenue, we don't expect um this item to show in your cost of sales at the same time. We don't expect it to show in your cost of sales. So what do we then do in this case? So what we'll do is that we need to go and keep the inventory somewhere also. Because we also has, if we are saying we are owing for a commodity that we have transferred out, then we should also have what we call inventory recoverable accounts. Because since we are also expecting inventory, we are also expecting inventory from that customer. So we would also have that, okay, oh, yes, this guy can return, that's fine. So we should also have an asset. So this one is what is representing what we are also expecting, the inventory we're expecting from the customer. So you need to debit this. So this one is hidden. A lot of you will just ignore this. So you take it to inventory account, you take it away from cost of sales. You take it away from cost of sales, you credit your cost of sales, you debit your inventory recoverable account. Just so that since you did not recognize revenue, so the item that you might have included it as part of your maybe purchases or what have you. You need to remove it from there and go and put it in an inventory recoverable account. An inventory recoverable account. So when the right of return expires, according to what Moses has mentioned, this is not the only entry you pass. As soon as you close out the liability account and credit revenue, you then need to also close out that inventory recoverable account. You close it out, then you take it back to your cost of sales. You take it back to your cost of sales. And this is the complete treatment. This is the complete treatment. So anytime you sell goods on right of return, you see, that goods that you sold on right of return, you cannot recognize it as revenue. It is a liability. Again, the inventory also, the cost of sales also, you need to recognize that you are also expecting inventory as an asset. Take it away from cost of sales. It's not, you can, because if you put in cost of sales, what are you going to match it with? That will be against matching concept. The cost of sales will be much more than your revenue. So you take it away from cost of sales, you take it to inventory recoverable account. So when that period expires, and it expires and the customer is not returning, then you can then recognize revenue. Then you close out the recoverable inventory recoverable account and recognize your cost of sales. Now, a simple scenario, you see, a company sells 1,000 units of goods at
Hello, sir.
10,000 per unit. Yeah, Moses.
Sir, but sorry, sir. In practice, let's assume that you have like 1,000 customers you are dealing with.
Yeah.
Virtually, you give all of them period of return. Now you have to treat all the transactions, all the goods you sold to all of them. You have to do it this way, sir.
Yes, sir. You have to do it this way.
All right, thank you, sir.
Yeah. So a company sells 1,000 units of goods at 10,000 naira per unit, which is 10 million. The cost of goods per unit is 6,000. The company estimate that 5% will be returned. This is how the question comes. So usually, it might not be all the goods that might have right of return. It could just be a portion of it. Like in this case, just 5% is what has right of return. So in this case now, so you identify the goods sold on right of return is just 5% of the entire goods, of the entire 10 million. How much does that give us? I think that should be like 500,000 or so, because 10% is 1 million. So it's 500,000. It's only this
100,000.
one. Yeah, 500,000. It's only this one that you're only going to debit bank and credit refund liability. Only the 500,000. And also, you also debit inventory recoverable, inventory recoverable account, but the inventory now, it cannot be 5% of a million, because the inventory is based on costs of the goods, is cost of the goods, which is 1,000 units times the cost of the goods is 6,000 in this case. That's 6 million. And that's how much is that? No, not 300,000. That's 300,000. And you can then credit your cost of sales. Okay. So this is the only part. You see, the remaining 95% can be recognized as revenue. So that's the idea. It's only the portion that is right of return that you would not recognize revenue. You see, the portion that are not, just recognize your revenue fully. So that's 9.5 million. This that you recognize revenue for the remaining part. So I hope you get the gist. I hope you get the gist here in this case now. So if I want to do my SOPL now, this is how it will look. I'll have my revenue is 9.5 million. I'll have my cost of sales. That should be how much is my cost of sales? Everything is 6 million.
300,000.
Okay, minus 300,000. That's how much. That should be
Okay.
5.7.
56. 57.
5.7. So then you get your profit. But this is like an extra, just for me to show you what goes into your P&L. Why in your statement of financial position, you have a liability and you have an asset in this case. So that's actually how sales and right of return, that's how you it. It's no more than that. I'll show you some past questions very soon. So do you have any question on this before we move to the next guidance? Okay, now let's talk on warranties. Warranties. So every one of you knows what. Okay, yeah, David, I can see your hand.
Please, can you help explain that cost of sale part again in the first explanation? Why we're removing from cost of sale and taking to
Inventory recoverable.
recovery.
Okay, all right. So I said that since we cannot recognize revenue for the goods that we sold on right of return because they can return, we said, okay, we should recognize the liability instead, since they can return, meaning this money that we collected, we might return the money itself. So therefore, the inventory that we're also expecting, we should also debit an inventory recoverable account as well, because we're also expecting inventory from them. So we are taking it away from purchases, we are taking it away from our cost of sales, and you are putting it in an inventory recoverable account. So this inventory recoverable account shows that we are expecting money from the customer. I say money, inventory from the customer. You put this inventory recoverable account under current assets. While your cost of sales, taking it away from cost of sales ensures that you are not overstating your cost of sales, because you know that the item, as soon as you sell an item, you match it with your cost of sales so that you can get gross profit. Now, since this item, you will have put it as part of your purchases, is there in your cost of sales, is there in your cost of sales, and you did not recognize sales. So you will just be overstating your cost of sales and understating your profit since you don't recognize revenue. So matching concepts does not allow that. So you need to take it away, really. You have to take it away from cost of sales. Otherwise, your account will not be faceless and misleading. So we take it away from cost of sales, we put it in an inventory recoverable account until that period expires. So did I answer your question, David?
Oh, yes, sir. And then the other side, the other part, so when the right of return expires, is it when
Yes.
it is returned or when it is not returned that we're doing the passing these entries?
Yeah, so this is when it is not returned. So when it is not returned, so that is where we can then recognize revenue. And that is then we can then recognize cost of sales. So we are closing out all these refund liability, inventory recoverable account. We are closing them out. They are not necessary anymore. We are now recognizing the cost of sales. We are now recognizing the cost of sales. So the reality is all these debit, this credit, this I'm doing. A lot of you that are not so good with that, You might not necessarily do it in the exam like that. You just need to have the understanding that anytime we sell on right of return, we don't recognize revenue. We recognize refund liability, and you need to take it away from cost of sales. That's the cost of the goods that the customer can return. You need to take it away from cost of sales. Have that understanding. And if they don't return and it expires, then we'll close it up. We would end it. We'll close out all the liability and inventory recoverable. So, and that is it. Is really, and I showed you an example. Okay, what if the customer returns? What would then happen? We said that what if they actually return? The exam might not really go in that direction, but what if they do? What if they tell us that before the date of expiry, the customer returned? What will happen? What will happen? I mean, I need all of these people that don't say anything in this class to even participate, just to be sure that you guys are following. So, what will happen? The customer did not actually return the goods. What do we do? What do we do to the refund liability? What do we do to this entry that we have passed? This entry we have passed. What will happen to this refund liability and inventory recovery? Anybody?
Okay, let me try, sir.
Okay, Mustafa.
Yes. Okay, so when the goods are returned, then we debit our refund liability. Sorry, refund liability. Yes, we debit our refund liability and we debit our inventory, because the goods will be coming back, and credit. What do we credit then? The rate of return as well. Yeah, we credit refund liability. So you debit inventory and credit refund liability. I hope I'm on
Okay,
track.
you tried, Mustafa. So,
Sir,
But,
please come
sir,
again with the question.
Can I contribute some more, sir?
yes, please, Hussein.
Sorry, the way I look at it, maybe it will just the reverse backward instead of making it. Thus, they will debit a refund liability and credit inventory direct with the number of goods returning back.
Okay, is that all? That's a good trial. It's just the same thing as what Mustafa has said. So, Moses, we're saying that if the customer actually returned the goods before the expiry, so practically, what happens is that we are going to pay back his money. That's what happens. We'll give him back his money. If he refunds, or probably we'll give him another set of goods like that. Okay? It's either we return back his money or you give him another set of goods. So you just need to reverse this account first. Debit refund liability, credit back. Do the opposite of this. And for the inventory, of course, this is recoverable. We credit it because we are not recovering anything, or we have recovered really because it has returned. So you credit it, then you go and debit your inventory back. Or just debit your cost of sales back. Debit your cost of sales back. And it ends there like that. It's just to do the reverse of what we have done. And everything cleans out totally. Okay, let's move away from sales and right of return. Okay, so don't forget the major issue in sales on right of return is that we do not recognize revenue. Rather, we recognize refund liability. Additionally, the cost of sales needs to be transferred. The cost of the goods that the customer can return needs to be taken to an inventory recoverable account. That's it. That's it, really. And when the period expires, then we can then close out refund liability to revenue. We close out the inventory recoverable account back to cost of sales. And that's it really. Now, you see, warranties. So a seller can provide I don't want to use warranties. Can provide opportunity for the customer to repair any damage on the goods sold at the seller's cost. So this is known as warranty. Now, we have assurance related warranty or service related warranty. So for the assurance related, so this is also called standard warranty. So this provides the customer an assurance that the goods will work in accordance with a predetermined specifications. So, I mean, yeah, I'm telling you that I'm giving you 5-year warranty that this product would not spoil. His engine would be fine, except if you are the one that if you break it, if you damaged it, it's not my fault though. If there is a power surge, it's not my fault though. Something like that. So most warranty that you find on most products, they are standard warranty. They are assurance related warranty. Okay, so that's assurance related warranty. But for service related warranty, so this relates to additional service the seller is rendering to the customer to enable the goods operates beyond the standard warranty period or for the goods to have some additional features. So the accounting treatment is such that the standard warranty, which are called assurance related warranty, will be recognized as a provision in line with IS 37 I might teach you this on Tuesday as a topic. I might hopefully start and finish this on Tuesday. Oh, no, Tuesday, okay. Wednesday next week. So IS 37, assurance release. So we recognize it. And this is measured at the best estimates of expenditure that is required to settle the warranty. I mean, you will have estimated how much you will spend to clear off the warranty in case of damage. Even if there is no damage yet, you still need to estimate the expenditure that is required to settle, should in case somebody comes. But you see the service related warranty. You see, the reality is that this represents a separate performance obligation. And the seller must recognize revenue on the consideration expected on this type of warranty. On this type of warranty. I think these people used to do it via poll. They're using an iPhone, so they will tell you that your warranty has expired. If you want to extend, then you need to be paying certain amount of money per month, something like that. So that's service related. So where a warranty, when you want additional service that goes beyond the standard warranty, then it becomes service related. And it becomes a separate performance obligation that the seller can then recognize revenue on. That is all for this. That is all for this. So this is quite straightforward. Now, let's look at this scenario just to make it clearer for you. So we have Premier Co. sells a machine for 196,000, which is the standalone selling price of the machine. The sales contract includes a warranty that provides assurance that the machine complies with an agreed upon specifications and will operate as promised for 1 year from the date of purchase. As a customer represents new business to Premier, it also offered additional extended warranty at no extra costs, which guarantees the machine will operate as expected for further 6 months after the standard warranty has expired. 6 months extended warranty are normally charged at 4,000. So let's say they give us this scenario. I'm supposed to explain the recognition criteria. So here, from the above scenario, there are two types of warranties present. There is the standard warranty that provides assurance that the machine complies with an agreed and it will operate for 1 year. Like that, provides assurance that the machine complies with agreed and we operate. Okay. So this should be recognized as a provision by estimating the expected expenditure that will be required to meet the guarantee obligations. Additionally, there is an extended warranty. Okay. At no cost. So the funny thing is that this is at no cost. So this provides that the machine will operate for further 6 months. Now, the reality is this, this is a separate performance obligation, and the entity must recognize revenue on this additional service. But the reality is, or the challenge is how much. So this is where step 4 of that 5-step model comes in, where you can allocate transaction price to the separate performance obligation. So since this service is provided at no extra cost, we will need to allocate transaction price to this performance obligation based on its standalone selling price. So how do we do this? So there are two performance obligation here now. We have two performance obligation. There is the machine and there is the extended warranty. Those are the two performance obligation. So what's their standalone selling price? The standalone selling price of the machine is 196,000. Where is it? This. And the standalone selling price of this extended warranty is 4,000. So the total of 200,000. The total of 200,000. So can you give me a proportion? Can you give me a proportion? So what's 196 over 200? Who can give me that? If you are not all stupid.
98%. That's 0.98.
Then, if this is 98%, and this is 2%. In that case, and then do allocation of the transaction price. What's the transaction price in this transaction? You can tell me what's the transaction price here? From this transaction here. It's 196,000. Because that's the price expected from this transaction. That's the consideration expected. It's 196. So is this 196 we are going to separate between machine and extended warranty? So what's 98% of 196,000?
192,018.
192,000.
92. 18 naira. Yes.
What about this one? How much is this?
3,920.
Good. So this is how we're going to recognize the revenue. So for the machine, we recognize 192.80.80. For the extended warranty, we recognize 3920. And that is it about warranties. Any questions? Any questions? Any questions? Now, the third one is principal versus agents. Principal versus agent. So, see, the reality, the way it has to work is that in every transaction, an entity needs to identify whether it's acting as an agent. You need to identify. So, a principal is a principal. That one is clear. So there are instances where you think you're an agent. You are the one that is selling, whereas you are just acting as an agent. All these Jumia, all these online service providers, most of them, all these Uber, all of these, all of them, they are majorly acting as an agent. So you need to identify whether an entity needs to identify whether it's acting as an agent. So an entity is acting as an agent if the following exists. Okay, number one is that the entity does not have inventory risk, in the sense that if anything happens to the commodity, it won't suffer a loss. Number two, the principal is responsible for the fulfillment of the service or goods. So ultimately, is the principal that will render the service. Is the principal that would render the service. The principal is responsible for setting prices. Is the principal that sets price? You're not the one that sets the price. Also, the entity, I mean, you that you're acting as an agent, is only entitled to a commission. Okay, and also the entity does not have credit risk. So in case there is a default by the customer, he does not have any credit risk. So in all these cases, then you are acting as an agent. So when an entity is acting as an agent, don't recognize your revenue is just your commission. So when an entity is acting as an agent, only recognize revenue to the extent of its commission. Otherwise, it becomes a challenge. It becomes a challenge, and you'll be overstating your revenue. And you might be overstating your profit as well. And you might even be paying VAT that you should not be paying, because when IFRS comes and sees your revenue, they will say, "Ah, this is a big company," whereas you only get commission, you only get a small cut. So that needs to be clarified. Now, let's look at this. It says, an entity operates a website that enables customers to purchase goods from a range of suppliers. The suppliers deliver directly to the customer, who have paid in advance, and the entity receives a commission of 10% of the sales price. The entity's website also processes payment from the customer to the supplier at prices set by the supplier. The entity has no further obligation to customer after arranging for the product to be supplied. Is the entity acting as an agent or a supplier? The entity is acting as an agent because the following exists. All of the following that I've mentioned here are present. We're told that the supplier delivers directly to the customer, so he's responsible for the fulfillment of the goods. The entity only receives commission, is only entitled to commission. It is who set prices? Is the supplier that sets the prices, and the entity has no further obligation to we have no credit risk whatsoever. So it's acting as an agent. So that's just the principle here that we want to learn under principal versus agent. Now, the next one is consignment. This is also another very straightforward one. And consignment, this occurs when a seller has dealers or distributors. So the key accounting issue here is whether the seller can recognize revenue when it transfers the goods to its dealers or distributors. So the seller is deemed to have transferred control then let us go this out. So under consignment arrangements, it is generally assumed that the seller has not transferred control to the dealer or distributor, and therefore cannot recognize revenue until the dealer sells the goods to the final consumer. And this is because the seller can request the dealer to return the goods if it's unable to sell, or it can transfer the goods to another dealer. Yeah. Number two, the dealer does not have obligation to settle the seller until the goods has been sold to the final consumer. Number three is that the prices are set by the seller. It's not the dealer that set prices. It's usually the seller that still set prices. So the accounting treatment is such that the dealer will not recognize inventory in its books because it is not its inventory. He will not recognize inventory in his books. Also, the seller will not also recognize revenue in its books and will continue to carry the inventory in its books. So continue to carry the inventory in his own books as well. So okay. Can somebody read this question for us, please?
Okay, I'll read.
Okay.
James Co. is a retailer of high-value item of diamond jewelry. A significant proportion of the items available for sale in James Co. store were handmade by Rochester Diamond Co. These items are held under a contractual arrangement with Rochester Diamond Co., the term of which specified that Rochester Diamond Co. retained the ability to change the selling price of the jewelry and that James Co. is required to return any unsold jewelry after a period of 9 months. When James Co. sells an item of jewelry to a customer, legal title to the jewelry passes from Rochester Diamond to the customer. James Co. has paid a significant deposit to Rochester Diamond Co. in order to hold the jewelry in his stores. This deposit is deducted on a proportionate basis from the amount payable to Rochester Diamond Co. when items are sold or is refunded in full if items are returned. James Co. is not required to pay in full for the jewelry until it is sold onto a customer. Should James Co. include the item of jewelry in its inventory balance?
Based on my explanation, can somebody give us a simple solution to this? Can this dealer, can he recognize this item in his inventory? So,
Yes, sir. The right response, sir.
please go ahead.
Yes, sir. Based on your explanation, sir, James Cook cannot recognize in his book, inventory book, because based on this question, the control has not been given to him. He don't has any control over the goods being given to him, the jewelry being given to him to sell.
Okay, what are the indicators? What prompts your opinion that it doesn't have control?
Yes, sir.
What are the indicators that shows that it doesn't have control here?
Because he's not the one that give out the price. The price is from the Rochester Diamond. So he doesn't have control over the price.
Okay. Oh, yeah. So, of course, you are absolutely correct. From here, this man who is the seller is the one that has ability to change the prices, and he can ask Jameson to return any goods that is not sold after a period of 9 months. So Jameson does not have control because this man can ask him to return the goods. And when he sells, legal title passes from the seller to the customer, not from Jameson to the customer. So it does not even pass. Now, he usually pay deposits. So this is where I'm going. These deposits that they pays, how are we going to treat it? So let's, from this paragraph now, this paragraph shows us that Jameson Co. cannot recognize the item of jewelry in its inventories, in its inventory balance. Cost, prices are set by the seller, who is this guy. Number two, the seller can require him to return any unsold goods within 9 months. Also, legal title passes from the seller to the customer. So it's not even in the picture at all. However, Jameson has made a deposit to the seller. So this should be recognized in its books as follows. You would debit a receivable account No credit bank. Because cannot debit purchases because they didn't buy. While the seller cannot recognize revenue. But rather, you will recognize debit bank and credit reliability payables. And that is how this is going to work out in this situation. Okay, so that's more of consignment arrangement. That's more of consignment arrangement. So the last one that I will touch is okay, before the last one, I will not say much on this. Let me just mention it. Bill and hold arrangements. This is not common. Okay. So here, a seller collects money for the sale of goods, but the customer has not received the physical possession of the goods. So the seller has collected money, but the customer has not received physical possession of the goods. So this was at the request of the customer. So in this case then, the seller is deemed to be rendering additional service to the customer, and hence it is separate performance obligation, and revenue should be recognized separately on this service. So usually like a warehouse service. So we need to identify that, and we need to recognize revenue separately for that service. So that's how that's the major argument. That's the major area here for bill and hold arrangement. So it's not like the seller says don't come and pick it. It's the buyer that did not come and pick the commodity. And in such situations, the seller needs to recognize revenue on that additional service, even if he is not collecting money from the customer. He needs to recognize that as a separate service. Like, okay, because this can go as a service, as a warehousing service. So that's bill and hold arrangements. Now, the next one here is repurchase agreement. Repurchase agreement. So, as the name implies, a seller transfers goods to the customer and agrees to repurchase the same goods after a certain period of time. After certain period of time. So the key issue here is whether the seller has transferred control of the goods or services to the customer. That's the key issue for us to identify whether he has transferred control. And it is generally assumed that the seller has not transferred control and therefore cannot recognize revenue in most cases. So repurchase agreements can be in any of these three forms. Number one, the seller has an obligation to purchase. We call this a forward contract. Number two, the seller has a right to repurchase. We call it a call option. Number three, the customer has a right to request for repurchase. We call this a put option. So this three is what would enable us determine how we account for a purchase agreement. So the above three forms will direct us on how to account for a repurchase agreement. So you need to know this three, and is highly testable at your level. The one that is this part I can often ask you. Can ask the other areas too, but you will find them asking either of these three. So just to be sure that you guys are still with me, just to be sure, because we have spent like 1.5 hours here now, almost. So can somebody tell me the difference between, they said a seller has an obligation to repurchase. The seller has a right to repurchase. I mean, of course, There's a clear difference, but I would need somebody to articulate that difference for us. Is there anybody that can do that? So when you have an obligation to repurchase, and when you have a right to repurchase, what's the simple difference between?
Hello, sir. Good evening.
Good evening, Eko.
Yes, sir. I think obligation has to do with the compulsion, the contractual binding to purchase to repurchase that goods. Why the right to repurchase, the seller can turn it down, and he can decide not to buy, and he can decide to buy depending on the condition.
Okay, thank you very much. Thank you very much. So he has explained it very clearly and is absolutely correct. So let me follow that line and explain this to you. Now, the first one is forward contracts. So here, the seller has an obligation to repurchase, which means that he is under compulsion to repurchase and cannot refuse. So he must purchase. Hence, the seller has not transferred control of the goods or services. So, revenue cannot be recognized. Rather, the recognition is either a financing arrangement or a lease arrangement. So here, since he must repurchase, since he cannot refuse to repurchase, since he's under compulsion to repurchase, so he would repurchase. So he has not really transferred control. He has not really sold. He cannot recognize revenue. Revenue cannot be recognized. Rather, what does he then recognize? The recognition is either a financing arrangement or a lease arrangement. So it is a financing arrangement if the purchase price is higher than the original selling price. Okay. If the repurchase price is higher than the original selling price, then it is a lease arrangement. So, as you can see, I am buying it much more than I sold to you. And that is why we are saying it is a financing arrangement. I'm paying much more. So, you see, the excess of the repurchase price over the original selling price is the interest on the transaction. That's the interest. That's the interest expense that seller is paying back. That's why he's paying more than he collected. Because we are going to treat it as a loan. That's how we're going to see it. That's how we're going to see it. So instead of him recognizing revenue, you recognize a loan. But it is a lease arrangement if the repurchase price is lower than the original selling price. So if the purchase price is lower than original selling price, then this is a lease. So, so in this case, the seller will only recognize a lease income over the period of the contract. So how much and all of that? I'll show you with an example now. So let me show you just 3 simple cases. The first case says entity A sells a machine to customer B for 100,000 on 1st January 2005. The contract requires entity A to repurchase the machine on 31st December 2007 for 120,000. Explain how entity A should account for this transaction. In this case, you see, this is a repurchase agreement, and it is specifically a forward contract because it requires the seller to repurchase. So in this scenario, the repurchase price of 120K is higher than the original selling price. Original selling price of 100,000. Hence, this is a financing arrangement. Number 1, the cash received of 100,000 by the seller will be recognized as a loan. Secondly, the excess of the repurchase price over the selling price of 20,000 will be recognized as an interest expense over the 3 years using an effective interest rates method. That is not given here in this question. So here now, this is how this transaction will be recognized, because the purchase price of 120,000 is higher than the original selling price of 100. So that's how I know. That's the judge of whether this is a financing agreement or a lease. Anytime we have a forward contract or where the seller must repurchase. So the difference between the two, the excess, because it's paying more, that means it's paying interest. It's paying interest. So for those that care, I've really solved it here. For those that care about journal entries, so with debit bank, credit loan, for the amount received for the sales of goods of 100,000. Then secondly, you will debit interest expense with credit loan for the interest expense recognized over the 3 years. And number 3, for the repayments, you will debit the loan and credit bank for the repayment of the loan with the 120,000. Okay, and this is done at the end of the period. The second scenario, which is case B, entity B sells 500,000, sells equipment for 500,000 on 4th January 2005. The contract includes a forward agreement requiring entity B to repurchase the equipment after 4 years for 450,000. You are required to explain the accounting treatment and justify whether this is a lease or a financing arrangement. Now, first is that this is a repurchase agreement, and specifically, it is a forward contract, as mentioned in the question. And from the case, the repurchase price is lower than the original selling price. Hence, it is a lease arrangement. It is a lease arrangement. So, and the seller will recognize a lease income of 50,000 as this represents, over the period, which is 4 years, over the 4 years, as this amount represents the effective amount paid by the customer for the temporary use of the assets. For the temporary use of the assets, as he initially paid 500,000 and then will later collect back or receive 450,000 back. Receive 450,000, let me not write back, pathology. from the seller. So he's effectively paying just 50,000. And that is why we are saying is a lease. So all the seller needs to do is to recognize the lease over the 50,000 over 4 years. So meaning that the seller will not recognize revenue and will also continue to recognize the assets in its books. You will not remove it. It will still be there, but it will not recognize revenue. It's just a lease income that is going to recognize in its books of 50,000. Okay, I just needed to finish this. And David, you were trying to ask a question. Do you still want to?
Let me just ask, yeah. I wanted to confirm. So when recognizing an amount as a loan, it doesn't have anything to do with what the company uses the amount for, right?
Yeah, it's not really a consideration. Whatever you use the company the money for. So what is important is your borrowed money.
Okay, sir.
Okay. So that is how that works. Now we have case C. This is entity C sells specialized manufacturing equipment for 2 million on 4th January 2005. The contract includes a forward agreement requiring entity C to repurchase the equipment after 5 years for 2.5 million. The directors recognize revenue of 2 million. Okay. I'm not going to repeat this because I've taught you this. So who can tell me, is this correct, what the directors have done? And if not, what should be the correct treatment? Anybody? Okay, I think you guys are tired. So I'll allow you go and attempt this. I won't continue. I would stop here. I'll finish up repurchase agreements within a few minutes in our next class. Then we would need to solve some past questions also. So I will share this material with you. Go and look at this case C and let me know by revising what I've explained so far. So apparently you're tired, you cannot follow anymore. I would see you guys tomorrow. For those of you that are doing case study, see you tomorrow evening. Thank you very much. Do have a wonderful night.
Okay, thank you very much, sir.
Thank you, sir.
You're welcome.